Welcome to The Debate. Today we're tackling one of the most persistent structural tensions facing a high-income professional, the liquidity dilemma. When the market turns sour, or maybe more critically, when your job confidence starts to wobble, is holding a significant cash emergency fund a source of relief, or does that cash just represent deep regret for missed compounding returns?
It really is the ultimate balance for successful professionals. They've achieved a high level of stability, significant investment assets, which, should theoretically liberate them from traditional financial anxieties. And yet, that old fear, that need for a safety net, it often leads to capital allocation choices that seriously undermine their long-term growth.
Absolutely. So the central question we're framing today is this. For high earners, people with substantial investment assets and demonstrated career stability, is maintaining a large dedicated cash reserve, say 6 to 12 months of living expenses, is that a necessary form of self-insurance against catastrophe? Or is it just an inefficient allocation that severely taxes long-term wealth creation? I'm going to argue that a robust cash reserve is essential. It serves as both psychological safety and a critical protection against truly correlated systemic risk.
And I'll be taking the opposing view. For this specific demographic, excess cash is an expensive, inefficient drag. It's a substitution of rational, holistic capital efficiency for what is really just simple financial anxiety management. Every single dollar reserved far beyond immediate needs is a dollar that fails to capture the long-term equity risk premium offered by the global markets. And that cost, when you view it over decades, it's staggering.
So my position really begins with the reality of the high-income lifestyle. It is an undeniable fact that high earners, particularly those with families, with established lives, they maintain high and often sticky fixed costs. We are talking about large mortgages, sometimes non-conforming ones, private tuition payments, expensive insurance premiums.
Right.
This creates a very high burn rate that demands a larger absolute buffer than traditional rules, which, let's be honest, were often formulated for entry-level professionals, might suggest. The fundamental shift in perspective here is that we have to view this emergency fund not as a growth asset, but explicitly as a form of specialized self-insurance. The objective is to avoid ever being a forced seller when the market is down 20%, 30%, or even more. This is insurance against the systemic career disruption that, based on all the historical evidence, tends to correlate perfectly with broad economic contractions.
That point about high fixed cost is well taken, and I agree that the absolute number needs to be higher. However, we just cannot ignore the other side of the ledger here, the opportunity cost. For sophisticated investors with decades-long time horizons, cash is fundamentally the most inefficient asset class available. It's sitting at the absolute bottom of the risk premium spectrum. The cumulative cost of foregone equity and bond risk premiums, it compounds severely. And look, this isn't a theoretical argument. It has been rigorously modeled. Research, notably from firms like Vanguard, suggests that for a long-term horizon, let's say 30 years, holding significant excess cash can sacrifice nearly half, up to 49% of the potential terminal value that those funds could have achieved if they were efficiently invested. We're talking about hundreds of thousands, maybe even millions of dollars lost, simply to maintain an unnecessary sense of static safety.
I'm just not convinced that focusing purely on that theoretical foregone return accurately accounts for the true utility of cash in a genuine high-stress crisis. When a high earner faces an income shock, that shock often coincides with a market downturn, meaning their entire portfolio is already impaired. Think of the senior partner laid off during a recession, or the specialized M&A lawyer whose sector just freezes overnight. Their highly specialized human capital means the job market is illiquid. The time required to find an equivalent replacement role can statistically exceed 6 months, sometimes lasting a year or more, particularly in these niche or cyclical fields. The cash reserve is the critical buffer that allows them to maintain their high fixed costs without having to liquidate assets at the absolute worst possible moment. And beyond the purely financial aspect, cash provides a deep psychological utility. It's a robust behavioral backstop. This emotional fortitude is what gives an individual the certainty needed to stay invested in their main portfolio during extreme volatility, preventing the panic selling that is the #1 cause of long-term underperformance.
Behavioral utility is important, I'll grant you that, but wealth is fungible. Instead of maintaining a large, dedicated cash bucket that is actively losing purchasing power to inflation, high earners should be viewing their liquid investments holistically. The efficient capital strategy prioritizes market exposure and only holds true cash for known near-term and short-time horizon expenses, typically those due in the next year or two. When we over-allocate to cash, we are prioritizing safety so aggressively that we actually increase shortfall risk for long-term goals. If your retirement or your kid's college fund depends on capturing the market premium over the next 20 years, well, sacrificing 49% of that capital's potential value means those goals might simply become unreachable. The decision has to be driven by capital efficiency first, not by fear.
Okay, let's address that efficiency argument directly, particularly your reliance on these alternative liquidity structures. Many argue that the high earner should leverage sophisticated tiered liquidity, specifically securities-based lines of credit, SBLCs, or home equity lines of credit, HELOCs.
Exactly. For high net worth individuals, the concept of a multi-month cash buffer is frankly obsolete when these options exist. An SBLOC allows a high earner to borrow instantly against their taxable brokerage assets, often at highly competitive rates, without having to sell a single share. This is tax-aware liquidity because it avoids triggering high capital gains taxes, which for top earners can easily run 20% federally plus state taxes. The core benefit is allowing the pledged assets to continue growing, theoretically capturing a positive spread between the borrowing cost and the market returns. It is a very definition of efficiency.
And I am profoundly skeptical of relying on these leverage tools for true emergency liquidity, precisely because they are what I call fair weather friends. During periods of systemic stress, the 2008 financial crisis being the canonical example, lenders fearing their own exposure routinely freeze or cancel these lines of credit. And this happens precisely when the borrower needs the capital the most. The mechanism is simple. If the market is crashing, the value of the securities pledged in your SBLOC is falling, reducing the lender's collateral. Simultaneously, if you've lost your high-paying job, your ability to repay has been compromised. The lender, motivated by pure self-preservation, exercises their contractual right to raise the loan-to-value requirement, demand principal repayment, or just cancel the line altogether. Cash, on the other hand, provides absolute control and is non-correlated to the banking system's stability, the housing market, or the stock market.
Well, while that systemic risk is a valid theoretical concern, we have to contextualize it for the high net worth client. A sophisticated client maintaining a conservative LTV ratio, let's say borrowing only 10 or 15% against a substantial portfolio, is statistically unlikely to face a crippling margin call or cancellation. Furthermore, the modern regulatory environment is designed to be more resilient than the 2008 era. Your perspective prioritizes avoiding a low-probability, high-impact event, but that avoidance comes at a guaranteed, measurable cost, the opportunity cost we already established.
For the high earner, the value of cash is measurable not just in the foregone interest, but in what economists call welfare gained, the certainty equivalent. That is the economic measure of the financial benefit you gain simply from having absolute confidence in your safety net. Cash is a hedge against the inevitable, negative confluence of experiences, Murphy's Law writ large. A job loss coinciding with a deep market downturn. Consider the extended period from 1999 through 2012, where the S&P 500 effectively produced zero real growth. Imagine losing your $500,000 executive salary in 2008 and seeing the remaining assets you had earmarked for your children's college tuition suddenly down 50%. The psychological pressure to liquidate surviving assets, the very assets you know will eventually recover, it becomes overwhelming. The potential loss from panic selling during that dual shock far outweighs any foregone interest on a cash reserve. Cash is a behavioral guardrail that protects the investor from their own worst, most emotional impulses.
That's a compelling argument regarding the psychological pressure, but we have to interrogate the cost of that anxiety management, right? For a high-risk tolerance individual or simply a rational investor who trusts the long-term data, cash incurs a greater cumulative cost because they receive less behavioral benefit from the reduction in volatility. Maintaining an inefficient cash allocation substitutes emotional management for rational decision-making, and this is especially expensive when we factor in the impact of tax drag. High earners typically hold their cash reserves in taxable savings accounts. The nominal interest earned is taxed at high ordinary income rates. When you combine that tax expense with inflation, the high earner often ends up with a negative real return, meaning their cash is guaranteed to lose purchasing power year after year. We're not just giving up potential gains, we are incurring guaranteed compounding losses. For individuals who already hold large, diversified, taxable brokerage accounts, sophisticated modeling actually suggests that including equities as part of the total liquidity strategy, that tiered approach, can actually reduce instances of funding inadequacy over the long term, compared to a pure cash approach. Which brings us to the structure of wealth and the duration of shock versus the duration of investment. High earners who have been diligently saving for many years are structurally less sensitive to short-term market dips. Even after a catastrophic 50% crash, long-held investments might still be positive overall, or at least far less impaired than a new investor's portfolio. The mathematical risk of losing the compounding benefit over 20 years is fundamentally larger than the risk of forced liquidation, provided the investor has access to any liquid assets, even if they must sell at a temporary loss.
I would frame that risk capacity very, very differently. It depends critically on the nature, the severity, and the duration of the income shock, which is directly tied to job specialization. For specialized human capital, we're talking senior roles in niche technology, specialized medical device sales, or high-level executive positions. The job market is highly inelastic. A new job takes far longer than the 3-month traditional advice suggests. We are talking 6, 12, or even 18 months for an equivalent role. Moreover, the loss of income is severe, and the subsequent role may require accepting a significantly lower starting salary or even relocating. This dictates a higher savings target, 6 to 12 months or more, based on covering essential expenses held safely in cash. And why? Because the time horizon for those specific funds, the capital needed to maintain the house and pay tuition while searching, is potentially zero. They have to be available instantly, without question and without recourse to a nervous banking partner. The cash acts as the required bridge during this illiquid time in the professional's career.
The issue remains that you are allocating an enormous amount of capital to sit idle, waiting for a statistically rare correlation of events. The sophisticated liquidity strategy minimizes this expensive drag. By reserving only a small amount for immediate cash flow, a month or two, and keeping the remainder in highly accessible, low-volatility assets, or utilizing the available contribution basis of a Roth IRA for emergency withdrawal, the high earner maximizes their capital efficiency while retaining immediate access. The whole purpose of wealth management for high earners is to maximize the long-term terminal value, and this strategy is fundamentally anti-wealth maximization. We should be optimizing for the long-term goal, not just hedging against the short-term worst-case scenario with a large, expensive cash allocation.
Ultimately, this debate, it boils down to the trade-off between control and leverage. My argument is that cash represents absolute, unconditional control. It ensures that in the worst-case scenario, that systemic crisis that perfectly correlates job loss with market volatility, the high earner is never dependent on the stability or goodwill of a lender or the current market price of their assets to cover their high fixed costs. This peace of mind is an insurance value that actively prevents wealth destruction caused by behavioral mistakes during times of intense stress.
I'm sorry, I just remain unconvinced that the long-term cost of this financial paralysis is justified by the marginal benefit of safety for individuals who already possess substantial accumulated wealth and high earning capacity. The efficient approach intelligently leverages the market's long-term risk premium while employing layered, tiered liquidity strategies that maintain access without sacrificing growth. Over-allocating to cash is fundamentally a failure to capture the systemic growth of the global economy, and that failure severely dampens the compounding required to achieve true financial independence decades down the line.
The choice is indeed highly individual and complex. It depends critically on one's career specialization, personal risk tolerance, and, proximity to major financial goals like retirement or funding education.
And the critical question that remains for every high earner is whether they are holding cash to manage real, near-term, catastrophic liquidity risks that alternative strategies cannot cover, or merely to manage subjective anxiety, and at what specific, quantifiable cost to their long-term compounding potential.